Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. So the S&P is rallying here quite violently. Last week, the S&P 500 gained 3.5%. That is as the market is finally beginning to front run a Federal Reserve pivot, a pause in the monetary policy tightening cycle that we've had since the beginning of 2022 that's brought down the markets as the Fed has been trying to fight the inflationary spike that we had throughout 2021 and 2022. So the market is now seeing the economy weakening enough, inflation coming down enough to begin saying, okay, we're seeing the end of this, and we can start pricing in the recovery that's going to come once the Federal Reserve begins to ease policy once again. Now, that, of course, is simultaneously happening as we have a vulnerable banking system, liquidity ratios coming down very violently over the last few quarters, coming down to similar levels that we had in 2008, that we had leading up to the 2007 recession, a very violent contraction in these liquidity ratios, and we continue to see depositors withdraw their money from the banking system at unprecedented rates relative to what we've seen over the past 50 years. So why is the stock market completely disregarding what's happening in the banking sector? In this video, I'm going to show you the actual signs that we are beginning to see that the banking crisis is leading us into a recession, why banks are lending less money, why businesses are having a more difficult time, and we're going to go over the three phases that typically lead us into a recession. We have the unemployment rate at the lowest level since the 1970s. We're not in a recession, but we are seeing very serious evidence that we are currently entering the last and most dangerous phase of the credit cycle. So that's what we're going to talk about in this video, comparing to some other similar points in history. Of course, don't forget, this is my opinion based on the research that we do at gameoftrades.net. We back all our claims with the research that we have on the website, but we don't have a crystal ball. So now, without further ado, smash the like button, subscribe if you haven't already, relax, sit back, and enjoy this episode. So again, bank liquidity ratios have been plummeting. Investors have been moving out of the banking system and into money market ETFs that have a much higher yield because of the tightening that we've seen over the last year. And so inevitably, that's going to lead to tighter lending standards. Talking about that for the last couple of weeks, banks throughout the last year have been tightening, which has often led to recessions, by the way. But the banking crisis we've recently had is likely to make things worse. But in fact, if you look at lending standards relative to history, this is a Bank of America chart that actually goes back to the 1960s, and you can see banks have been tightening very severely here. And again, we've never seen that not lead to a recession. So there's a lot of confusion regarding this. If banks are tightening so much, if they've been doing that over the past year, why are stocks still moving higher? Why is the economy still growing? If stocks haven't crashed by now, then perhaps they never will. But we are beginning to see real signs that this is having an impact on the economy. And if we look at the chart of loans and leases in bank credit, which is how much banks are actually lending out money, the total number of loans and leases that banks are actually making, the most recent data point right here is showing that that's actually starting to happen. So that's where the three steps come in. First of all, the Federal Reserve tightens monetary policy. It raises its federal funds rate, it tightens monetary policy, but that's just the central bank. The next step after that, you start to see domestic banks, the actual banking network, tighten its lending standards. So they start to be a lot more picky to who they actually lend money to. And that's what we've seen over the past year. We've seen these lending standards tighten significantly. And then the last part is that that's actually reflected in the number of loans and leases. And that's when people can't get loans, businesses can't get loans, they can't refinance, the economy stops growing, and you head into a recession. And that's usually the phase where stocks are crashing, unemployment is rising, corporate earnings are also contracting in this period. And so you can see up until very recently, we've actually had loan growth move up rapidly. We've been in an economic boom here where banks have been lending out money even until the third quarter of 2022. Despite the fact that banks here were already tightening monetary policy, banks were making loans. In fact, if I put the two charts one on top of the other, you can see in the initial stages of the tightening, the red line is the tightening of the lending standards in the initial phases. For example, here in 2006, banks were tightening standards, but banks were still actually lending out money. And so that's what actually happened in 2022. Banks were tightening, but the economy was still so strong that people and businesses were taking out loans. And now we've just seen the first data point right here on the 24th of March that shows us that we're seeing a pretty aggressive rollover in the number of loans being made. So if we assume that this continues to move down, and if we look at previous moments where tightening standards, that red line here, was this high, so lending standards were this tight, it systematically led to a decline in loan growth in the past three recessions, 1990, 2000, and 2008. Well, we can actually pinpoint the exact moment that are similar to today in the last recessions. So that's exactly what we're going to try and do here. Starting right here in 1990, you can see loans rolling over very hard in Q1 of 1990. Lending standards were very tight. Lending standards were high at that moment. And then a few months later, you had the recession. If we look at where the stock market was in the first quarter of 1990, right here. So of course, 1990 wasn't a massive bear market, but you still had a recession and earnings contracting. You also actually had the unemployment rate, if we add the unemployment rate after that, very quickly begin to rise. And that's when the stock market was moving down. So that's the recession getting priced in. In 1990, it got priced in very, very quickly. The market quickly saw through the recession after the initial unemployment rate rise, and the market started rallying. It's possible that we see something similar, but don't say that the recession today has been priced in, right? You can say that there's not going to be a recession and that we're going to see the unemployment rate stay low, but there's definitely no recession being priced in right now. Let's look at 2000 right here. Loans and leases began to roll over right here, and that was actually the fourth quarter of 2000. Lending standards were very tight and loans and leases began to roll over, and a couple quarters later you had the recession began. If we look at where the market was in the fourth quarter of 2000, it was right here. Fourth quarter of 2000, the market had already began to move down. That was primarily due to the tech bubble popping and valuations contracting at that moment, right? That was the initial leg down of the market, tech moving down very aggressively. But the second part of the 2000 bear market was actually the recession getting priced in. And again, right after that, very quickly, unemployment began to rise. And then, of course, you had this one right here. Between the first and second quarter of 2008, you can see banks and leases in that area beginning to roll over. Tightening standards are very tight, so that actually occurred at the very beginning of the recession. If we look at where that is on the stock market between the first and second quarter of 2008, was around in this zone, actually during the notorious bull trap in 2008 here. Now that, of course, was a very violent bear market again. Could that happen this time around? Sure, I don't have a crystal ball. But whether you're expecting a 2008 or a 1990 recession, as long as you're expecting a recession, you're going to have to be prepared for that type of environment. And again, right after that moment right here, unemployment began to rise more aggressively. It had already risen leading up to that moment. So a bit different to 2000 and 1990, where those instances really marked the bottom in unemployment, and the recession actually followed a few months later. In 2008, the recession had already begun at that moment. Now, if we look at another chart that we actually talked about last video, it tells the same story. This is a survey of small businesses, what they're actually reporting about credit and how difficult credit is to get. So that speaks to how easy it is for small businesses to refinance. And you can see that's been rising. So if we compare the dates that we just discussed between the first and second quarter of 2008, right here, final quarter of 2000, right here, and first quarter of 1990 right here, you can see you can definitely argue the similarity we have between those three instances, those three recessions, and what we have today. So yes, stocks are getting very excited about a Fed pivot, and that can definitely have a lot of power in the market. That was actually one of the big reasons why we were bullish back here in 2022, because the economy was strong. We were not heading into a recession back here. The consumer was very strong. Inflation was coming down. And so had the Fed been a little bit more dovish, the market could have ran higher. Right now, you're seeing the market price in a Fed pivot very rapidly. That can lead the market to higher valuations in the short term. But as soon as you start to see those recessionary signals materialize, and that seems to just be a few months out, it's going to start to get priced in by the market, and the rally is going to hit a big wall. So we've actually updated our model portfolio feature on our website. We made a complete revamp of that feature where you can easily access the updates that we make on the model portfolio, the actual performance tracked against the SP 500, all the weights, the performance of the current positions. This is really a special feature that we're putting a lot of effort in. I do believe that we are the only website that actually actively tracks the performance of our trades completely transparently against the SP 500 index, because the goal is to make you guys outperform the market on a consistent basis with the help of the trade ideas that we provide on this portfolio. So if you are interested in that feature, make sure to subscribe, get yourself a free trial. I'm sure you won't regret it. Now that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash the like button and subscribe to the channel if you haven't already. Now in the meantime, I wish you good luck on your trading and see you next time.